Welcome back. You're still watching Trading Hour. For now, it's 120 points higher on the Nifty. The mid-cap index is doing a lot better right now. Actually, that's also come off a little bit, so it's around 230 points higher on the mid-cap index, pretty much in line. But the Nifty bank is where we're seeing some weakness, and it has moved into the red now. It's an over 80-point cut that we're seeing on the Nifty bank. Let's get a market conversation going. Satish Ramanathan, Managing Director and Chief Investment Officer of Equity at JM Financial Asset Management, joins us now. Mr. Ramanathan, good morning. Thanks a lot for joining us. This is Pavitra. In this situation where we have the earnings season just starting right now, we have all of this uncertainty as far as the US Fed is concerned. We have the Russia-Ukraine crisis playing out. COVID is once again back, as far as what we're tracking. How would you approach the market at a time like this? And are there any sectors that you think are a complete avoid at this point?
In general, what we find is that the inflationary pressure may dent profit margins to some extent. However, what we find is that if I were to look at the 1-year basis, actually corporate profits have been moving up nicely, and consequently we believe that trend may probably stop or cease for some time till this inflationary pressure eases back, and after which earnings growth will move along. So in terms of sectoral avoids, we don't have any as such. It's only about valuation and growth where we see more value relative to the growth that we have determined, and that is what we are looking at this juncture.
Satish, morning. Reema here. So if EPS upgrades very difficult at a time like this from here on, and valuations are on the higher side, what do you think the markets will do on an aggregate basis?
On an aggregate basis, we have also anticipated that markets would probably move around the range for about 6 to 12 months. If we look at the past 6 months, markets are down about 6%. On a 3-month basis, it's down 3.6%. On a 12-month basis, however, markets are still up 20%. So a lot of this is already factored in. There will be stock-specific or sector-specific issues that we need to focus on. For instance, the banking and financial sector has cleaned up its books, and that's where we anticipate the highest earnings momentum to come through. And so there are a lot of sectors and bottom-up stocks that we need to identify and build into the portfolio for getting a reasonable result.
Hi, Satish. Morning. We've seen increased volatility now. For people who are looking to put in, fresh money, do you suggest that they wait it out or stagger it, since you said that, you expect the market to remain sideways for a considerable period now?
I think a staggered approach is more reasonable given the external volatility that we are seeing due to Ukraine war and commodity prices spiking and going up and down, things of that sort. So the volatility factor has increased, and therefore a sensible approach and strategy would be to build it up in a staggered manner, because neither valuations nor earnings growth are extremely favorable. The India story looks very good, but then if we look at it compared to last year or 2 years back, the earnings upside is limited to some extent.
Mr. Ramanathan, how do you look at the IT pack? Just a while ago we were talking about how some of these stocks which have declared earnings so far, 3 or 4 of them have, even if they've posted good earnings, like the TCS, they've seen quite a sharp move downwards, right? So do you think that either, the discount that we're getting them at right now is a good sort of entry point to look at them again, or do you think there's lots more correction here and we should stay out of this space for a bit?
In general, what we like about the IT sector is that it's not capital intensive and it generates significant amount of cash flow, which it can use to either acquire businesses inorganically or pay back to shareholders. So that is a fundamental aspect of the IT sector that we like. And in volatile environments such as this, the IT sector would continue to find favor because of this volatility on the global arena in terms of input cost and demand contraction, etc. Now, coming to the IT sector recent volatility, I think it's also been one of the sectors which has seen a sharp run-up on basis of these fundamentals. And consequently, when the earnings are a little depressed, people tend to sell on news. And we think that it's still one of the better sectors to hold in this kind of a market.
Better sectors to hold, the long-term thesis, the demand remains very much intact. I guess one needs to just tide out the current volatility that we are seeing. What about commodities? That's where the bulk of the EPS upgrades has been in the last 3 months. Has the street priced in the best case scenario, or do you think there is scope for more upgrades?
No, I think the fundamental thesis on commodities is that with the breakdown of global trade, commodities has become a local market. The steel market used to be an international market and now has become a relatively more local market. And that gives an upside because steel, the threat of imports not being there is itself a positive. And steel demand has been moving up nicely, and supply has consolidated, which is a big positive. So the top 5 or 6 steel mills now account for 70% of production, and that gives some credibility to this move. And probably it may not sustain here; it may drop a little bit. But the steel industry has deleveraged, reduced the volatility of earnings significantly, and that's a positive. So we do expect some kind of a pullback in commodities, but not to the extent that the street is building up.
Okay, maybe some pullback in the commodity names, and you also said that you like IT for a long-term idea. Mr. Ramanathan, thanks a lot for joining us. We will leave it at that today. Let's get into a short break now, but as we do that, here's something that you, our viewers, must take note of. CNBC TV 18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investors, that empowers you to make the right decisions with your money.